Hello, options traders. Well, a term you're hearing of a lot these days is futures contracts. We hear that the S&P 500 futures were up 300 points overnight, or the S&P 500 futures were down 1,000 points overnight. It's every single day in the headlines, and I'm having traders asking, well, what in the world are these S&P 500 futures contracts? What are they telling us? How do we read them? Well, those are all good questions, and they certainly help with trading. But I thought it would be helpful first to talk a little bit about what is a futures contract. Well, a futures contract, as the name implies, is a contract. It's a legally binding contract, just like an options contract. That's why they trade in contracts. The difference is with a futures contract, you are agreeing on a price today, but taking delivery of something in the future. So the big distinction between the futures and the options is that if you buy an option, you have the right to buy or the right to sell. With a futures contract, it is an obligation unless you close out the contract. Now, it sounds like kind of a strange deal, but believe it or not, everybody in here has used a futures contract at some time or another, just under a different name. So for example, let's say you go to a car dealer and you find this new car, flashy car trading for $30,000. The dealer says, unfortunately, they're hot sellers right now and we don't have any on the lot. We won't have any for another 2 months. So what's the risk here? Well, the risk is that if you come back, the price might be higher. And to the dealer, he either might lose you as a buyer or the price might be lower. So wouldn't it be nice if we could seal the deal right now, but just not take delivery until the future? So you wheel and deal, you say, okay, I'm willing to buy it for $28,000. Dealer says, okay, we're willing to sell it for that. And you draw up a contract. But notice that you are taking a contract here to be the buyer. It's not a right. You're the buyer. You just don't have delivery of the car yet. So the dealer might say, give us a small $500 good faith deposit, and then you will take delivery in 2 months. That is a futures contract. Now, technically speaking, that's actually what's called a forward agreement because it was privately negotiated. But futures contracts are exactly the same idea, but they're just standardized contracts that trade on a formal exchange. But the concept is exactly the same. So who uses futures contracts? Well, they're primarily used by hedgers and speculators. Bigger users are probably the hedgers. So hedgers are traders who use futures contracts to reduce a pre-existing risk. It's a risk that's already on their books. So if you are a seller of a futures contract, you want to hedge against falling prices. Isn't that the risk if you're the seller? You don't care if prices are higher in the future, but you're going to be disappointed if they're lower. And you can hedge that risk with a futures contract. Buyers, on the other hand, want to hedge rising prices. They don't care if prices are lower in the future, but they do care if they're higher. So what happens is we've got buyers and sellers faced with opposing risks. So a key concept of futures contracts is to recognize that we have buyers and sellers faced with opposing risks. And because of this, they can negate them with a futures contract. So for example, let's say that we have a farmer who is a producer and we have Kellogg's, who is also a producer, but they're just on opposite sides of the spectrum. The farmer produces corn. He would like to sell the corn, but Kellogg's needs to buy the corn. So even though they are producers of corn products, let's say, they are on different ends of the process. And so they are faced with opposing risks. So what could happen? Well, it takes about 3 months to produce a corn crop, and a lot can happen in that time. And let's say that we have a very high, unusually high crop yield, and or we have very low demand. And if that happens, we're going to find that the price of corn is low. But what else could happen? Well, we could have a very low crop yield and or very high demand, in which case the price is high. So we're faced with uncertainty. We don't really know what's going to happen, and that causes problems for the farmer and for Kellogg's. They don't really know what their profits or losses are going to be. They can't manage their cash flows because they are just dealing with uncertainty. until they enter into a futures contract. So how would they both fare? Well, let's say that the farmer sells a futures contract today for 4. He goes into his broker's platform, sells at 4. Boom, he gets a fill. You've sold at 4. What that means is that he is obligated to sell 5,000 bushels at a price of 4 at expiration. It's an obligation. Kellogg's does the same thing. They enter in their platform buy, they get filled at 4. They have an obligation to buy at 4. So the first thing to notice is that the buyer and the seller are both perfectly happy buying and selling at 4. That's important. That's totally what they're fine with right now. It helps them, again, to manage the risks. They know their cash flows. They can manage their business. It helps us to get lower prices because Kellogg's knows its costs. So they're both fine with these prices. But what happens when we get to expiration? Chances are prices aren't going to be exactly 4. Well, let's first assume that we get to expiration and market prices have gone up and corn is trading for $5 a bushel. What's going to happen? Well, one choice is the farmer could say, I'm just going to go through delivery and I'm going to deliver my corn and sell for the contracted price of 4. But going through delivery is not really all that easy. A lot of steps and only certain locations where you can do it. So what most people do is deal in their local markets. So what would likely happen is the farmer would say, I'm just going to close out my contract. Okay, I shorted it at 4 and I have to buy it back at 5. I am down $1 on my futures contract. But now that I've closed out that contract, I get to go into my local market. And the good news is I get to sell for the higher price of 5. But I do also have to account for the $1 loss that I took in my futures contract here. So what's his effective selling price? He sold for $4, exactly what he wanted to do. How does Kellogg's fare? Well, they bought the contract at 4. They could take delivery and pay the lower price of 4. But once again, it's hard to go through delivery. So what they would most likely do is say, let's just close out our contract for the market price of 5. We made a $1 gain on our futures contract. But now we have to go into our local market, and the bad news is we have to spend $5 a bushel. Good news is we collected $1 from our futures contract, so what's the net cost to us? It is a cost of $4, exactly what we were willing to pay 3 months ago. So the point to see is that by using the futures contracts, both parties, the buyer and the seller, got exactly the price that they were willing to trade at 3 months ago. But you can see why the financial press would have fun with this, and they'll look at a seller, let's say, big corporation that takes hundreds of millions of dollars of losses and say, see, futures contracts are dangerous. They got exactly what they deserve for speculating in the futures markets. Shame on them. It was such a bad deal. Well, no, it wasn't. They did it because they wanted to lock in a known price. But if you just focus on this portion, it certainly looks like it was a bad deal. But when you see the entire picture, it's because it forced them to get exactly the price that they were looking for. What happens if the price instead falls? Let's say the corn is trading for $3. Now it's just the opposite. The farmer would most likely say, I'm just going to close out my contract. I shorted at 4. I can close it out at 3. That's a $1 gain to me. Now I get to go into the open market and I'm going to sell for the local price of 3. So I'm going to collect $3, but when I account for the $1 gain on my futures contract, my effective selling price is 4, exactly what I wanted 3 months ago. What happens to Kellogg's? Kellogg says, we're under contract to pay 4. We could close it out for 3 right now. And if we do that, we're going to take a $1 loss on the contract. Now, the good news is we get to go into the local market and only spend $3. But once we account for the $1 loss on the futures contract, our effective purchasing price is $4, exactly what we wanted 3 months ago. So the main point to understand is that the futures contracts are used by people who are buyers and sellers of goods and services or products, agriculture, oil, lots of different commodities, but they take time to produce. And so there's a big uncertainty between the day that they start to produce it versus the time that they're going to collect the cash. And so if they agree today at a price in the future, they can exactly negate those risks, and both parties are better off. And it can only be done through futures contracts. So hopefully that helps you to understand the basics, and also helps you to understand why using derivative contracts, whether futures or options, can help you to hedge risks. And both buyers and sellers can become better off if you know how to use them. For those who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.